Navitas Semiconductor Corp is currently experiencing a closed market session, with the stock finishing the last trading period on May 21, 2026 at 4 p.m. EDT at an exact price of $24.38, capturing a significant single-day surge of 6.05% or a gain of $1.39 on an absolute volume explosion of over 37 million shares. While most retail investors looking at the basic stock charts think this sudden liftoff is just another speculative clean energy or power chip rally, the reality is far more calculated and dangerous. What the broader market completely missed during this massive volume spike is a quiet institutional short-covering frenzy that was triggered by a product deployment partnership in India, meaning this massive upward move is less about immediate cash flows and more about a brutal squeeze on short sellers who are caught betting heavily against the company's high-powered data center pivot. When looking at the broader market, anyone actively tracking Tesla stock or monitoring the rapid institutional accumulations inside Nvidia stock can see a common thread. Investors are desperately hunting for the hidden infrastructure links that keep these computing giants running. The standard expectation surrounding Navitas is that because it sits within the hot space of gallium nitride and silicon carbide materials, it should naturally ride the coattails of the larger artificial intelligence hardware trade. However, the cold reality hidden in recent financial disclosures shows that the underlying business is actually in the middle of a painful self-inflicted revenue contraction. The headline numbers show that revenue recently plunged nearly 40% year over year to a meager $8.6 million for the quarter. To the average user browsing popular investing sites or checking their individual brokerage accounts, a 40% top-line drop accompanied by a 1,000% trailing 12-month stock rally looks completely insane. This massive divergence between the stock price and the current revenue run rate is creating an extreme level of tension in the market, forcing a complete rethink of how small-cap chip designers are valued when they decide to radically alter their business models. The massive trading volume we just witnessed highlights a huge battle between institutional short sellers and aggressive retail momentum. Navitas entered the month with short interest sitting at more than 21% of its outstanding shares, which represents nearly 28% of the float available for public trading. When a business carries that much pessimistic weight, any positive headline acts like a match in a power keg. The catalyst that sparked this latest trading frenzy was a comprehensive product partnership with Semiconductors to launch several new high-performance power applications tailored directly for the Indian infrastructure market. Retail traders using apps like Robinhood or executing active trades on the Interactive Brokers platform piled into the stock, forcing those heavy short positions to buy back shares at a rapid clip to cut their losses. This short covering dynamic, combined with the momentum from the company's recent product showcases at the PCIM Industrial Conference, pushed the stock way past its consensus Wall Street price targets, which had previously hovered around $14. To really understand what is happening under the hood, you have to look at the massive shift in trading volume and the technical moving averages. The stock has been trading well above its 50-day moving average of $13.21 and its 200-day moving average of $10.38, showing a massive structural upward trend. But while retail investors might see this as a straight line up, professional wealth managers reviewing the company on a Fidelity trading platform or examining sector allocations inside Fidelity Investments look straight at the structural cash burn. Navitas has consistently burned between $44 and $66 million in free cash flow every single year since it went public, without a single quarter of positive free cash flow to show for it. The consensus estimates for the full year of 2026 point toward a net loss of roughly 17 cents per share, which means the company is purely living off its balance sheet cash while it waits for its high-power data center products to scale up. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you are completely avoiding this massive small-cap chip volatility right now. This extreme tension between expectation and reality makes Navitas one of the most polarizing setups in the entire semiconductor space. The market narrative says that because the company's AI infrastructure revenues jumped 50% sequentially, the business is on the verge of massive financial success. The actual corporate reality is that management deliberately walked away from its legacy low-margin mobile phone and consumer charging business in China to focus heavily on medium and high-voltage industrial systems. That consumer business was dropped incredibly fast, but the specialized high-power replacement revenue from data centers and utility grids is taking a lot longer to show up on the income statement. This leaves a massive revenue gap that the company is trying to bridge while trading at a forward price-to-sales multiple that sits north of 90 times, vastly outstripping the broader semiconductor industry average, which usually sits closer to single digits. Investors managing their personal accounts through options like a Schwab Intelligent Portfolio Setup or basic online investing platforms have to ask themselves if they are paying for a real fundamental turnaround or just a massive wave of speculative hype. If you look back at how the underlying business model was originally constructed, Navitas started out in 2014 with a heavy focus on mainstream consumer electronics, specifically designing efficient power components for mobile chargers. Traditional silicon chips hit major physical limits when dealing with high voltages and fast heat dissipation. By using gallium nitride and silicon carbide, Navitas could offer much faster charging speeds in much smaller physical packages. This model allowed them to hit gross margins of 45% back in 2021. But as the mobile charging market became flooded with cheap commoditized components in China, those gross margins dropped down to 31% by 2022. Management realized they could not win a prolonged price war in consumer tech, so they pivoted toward heavy industrial infrastructure, electric vehicle charging networks, solar inverters, and massive server farms. This industrial pivot completely alters the long-term outlook for the company, presenting a clear split between short-term risks and long-term opportunities. The ultimate bull case for the stock relies entirely on the massive electricity demands hitting the utility grid. As tech giants build out multi-megawatt server clusters, traditional electrical grids are struggling to support the load. Navitas claims that its specialized power platforms can capture a massive addressable market in grid infrastructure by 2030, driven by an incredibly high projected compound annual growth rate for specialized power materials. If the company can successfully scale its industrial power platforms and get its quarterly revenues up into the high $30 million range, it could finally hit structural free cash flow break-even and validate this massive valuation. However, the near-term bear case remains incredibly heavy. Navitas is still a tiny operation with less than $10 million in quarterly revenue, yet it is trying to compete directly against massive, well-capitalized chip giants like Texas Instruments, Infineon, and ON Semiconductor. These massive competitors have huge balance sheets, internal manufacturing plants, and long-standing relationships with global automotive and industrial clients. Unlike Navitas, which operates on a fabless model and relies on third-party silicon foundries, these massive players can easily absorb pricing pressures and outspend on research and development. This means that while retail traders on a basic online investment app might be celebrating a massive short squeeze, institutional analysts tracking the stock are looking closely at whether the company will be forced to dilute shareholders with another major capital raise just to keep the lights on before those long-term contracts start generating real revenue. When you weigh the massive expectations against the strict fundamental reality, Navitas stands out as an incredibly high-stakes bet on the physical limitations of the power grid. The market has rewarded the company with a multi-billion-dollar market capitalization based entirely on the promise of its technological superiority in managing data center power efficiency. Yet the hard numbers reveal a business burning through cash, suffering from a temporary top-line revenue collapse, and facing intense competition from established semiconductor giants. The recent stock surge to $24.38 reflects a powerful combination of intense short covering and retail momentum rather than an immediate change in underlying cash flows. For long-term investors looking at this through sophisticated platforms or managing their own self-investing strategies, the core challenge is surviving the immense quarterly volatility and cash burn while waiting for the industrial revenue to finally materialize. The tech behind their power platforms is completely real, but the bridge from a tiny $8 million AIM run rate to a self-sustaining industrial powerhouse is going to take a lot more time, patience, and capital than the recent 1,000% stock chart explosion would ever lead you to believe. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.